In this episode, we're talking with Strachan Taylor from Helia, Australia's leading provider of lenders mortgage insurance, or LMI. And we're going to discover exactly what lenders mortgage insurance is and how it works, how often are claims made, and even though it adds to the cost of purchasing a property, why it's not always something to avoid.
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
Our guest today is Strachan Taylor, Strategic Partnerships Leader at Helia, formerly Genworth. With over 30 years' experience across the banking, mortgage broking and insurance industries, Strachan is an expert in helping people understand how LMI works and how it can help make home ownership more accessible, which is good because a lot of people have no idea how LMI works. And I don't think we've covered this topic in more than 350 episodes. So it's high time we did. Thanks for joining us today, Strachan.
Thanks for having me.
Strachan, absolutely. We are long overdue, and I can't wait to have a bit of a chat today. And I actually don't know. I probably should know. I've recommended LMI for a decade, to be honest. Where did it all start? Like way before I was probably born. But what's the story?
Yeah, no, great question. And in fact, it was probably just after I was born, showing my age. In 1965, it all started in this country. And look, the reason for it was up until that point, you actually had to save 20%, right? And generally what happened is mum and dad brought you in to see the bank manager when you're about 10 years old, and you set up a savings account. And then you put money into that savings account through mum and dad, and then you got a job and all that sort of stuff. And also, when you had your 20% deposit, you then went to that bank manager, who was probably still there, and asked him for a loan. He was the credit department, the lender and everything. And that's how it operated. But what was happening, a bit like today, is people were really struggling to save that 20% deposit, even back in 1965, right? So that's almost 60 years ago. And so what the government did is they created a company called the Home Loan Insurance Corporation, who actually would develop to provide lenders mortgage insurance. So they would insure the lender so that if there was a loss, it wouldn't impact the lender, right? And therefore, the lender wouldn't lose money to lend out again. It wouldn't sort of pressure the financial system. And the contract, if you will, was the lender would say to a borrower, I can lend you up to 95%, but I need insurance. If you're willing to pay for that insurance, then I'm willing to lend you the money. And that's where it all started.
And I mean, 60 years ago, right?
Yeah.
And it's still the way it is now. Has there been any times when, over that 60 years, where that status quo's changed? Has it ever?
No, it's interesting. No, it hasn't. And look, a lot of it's based on statistics. So as you go up the sort of LVR, loan to value ratio curve, at about 80%, the loss ratio ticks up quite significantly, right? And then again at 90%. And so a lot of much smarter people than I have done all this analysis, and the banking system had done that analysis. And so that's where that bar, so to speak, was put at 80%. And look, to be fair, over the last 60 years, the smarts of writing credit have got better and better and better, right? And so we still get losses, and it's cyclical. So, we've had some very big drags on our finances. If anyone remembers, way back in 92, there was a housing crash. There was the mining crash, so that created some things in about 2012. There's some big ones right that where we had to pay out. But what us being able to pay those claims means that lenders don't lose money, therefore their depositors don't lose money, their shareholders don't lose money. The financial system is actually protected, and we carry on. And so that's essentially what we're there for.
So, but it was originally a government provide that insurance.
Yes.
Right? A little bit like this 5% deposit scheme that they brought in recent years.
Correct.
We'll talk a bit more about. But when did you go from the government's hand to
private hands.
Yep, in the 80s. So in the 80s, they sold to GE.
Right.
If you remember back then, GE were doing a lot of acquisitions in this country at the time. And then what GE did in the 90s, I think it was, they actually listed, they hived off the mortgage insurance business, which was global, and they had businesses in the UK and in the US and Canada, and they hived that off and listed it as a public company on the New York Stock Exchange in about 94. Right. And that's where Genworth was created, right. Sort of GE and Worth sort of bringing that together. And then they listed on the Australian Stock Exchange in the early 2000s. And Genworth sold down 48% of its shares. And then in 2020, they sold the rest of those shares out, and that's where Helia came to be. And we are now 100% publicly owned, but on the Australian Stock Exchange.
And you're not the only one that plays in this space. So you may be,
no.
There have been competitors over the years. What's the sort of landscape?
So, so the competitors, so QBE is probably our actually, interesting you say that. QBE used to be our biggest competitor. Now with the government scheme, they are our biggest competitor. And then there's two groups that use essentially their own insurance. ANZ insure themselves, and Westpac use a USA company called Arch to do their insurance.
Interesting. So I was going to ask you about what has been the impact to your business from the federal government stepping in and guaranteeing a certain amount of first home buyers. And I mean, that was, 2019 it was election promise. And did you guys know it was coming?
Nope. No. The classic, look, it was a thought bubble on a Sunday night by the Liberal Party about they didn't think they'd get into. They were desperate for things to do. It has been something they've been kicking around, we understand, but we'd never been, the industry hadn't been consulted. So classic politicians. But look, there was a need, right? So when it was launched, I think they got a surprise they got in. First of all, they went, now we're going to make this happen.
Yeah.
The initial one was 10,000 places, right? And 10,000 places makes sense because a lot of the people of that 10,000 couldn't afford LMI in the first place. Yeah. So they were actually meeting an unmet need, and that made sense. But then politicians can't help themselves, so that quickly went from 10,000 to 50,000. That's a different ballgame, right? That's a lot of business taken out of the industry. And look, it's making it works for a group, but to be quite blunt, there's a lot of people who use it who really probably don't need it. Okay, but it's out there, and if you can access it, then go for it. I mean, I'd prefer you write LMI, but you can't pass up something that's free, and it's free. Okay, so that's where we are today.
Yeah, I mean, how could you possibly pitch to a first home buyer that you're better off to paying LMI?
No, look, in that case, you can't. As long as they fit, if their income fits, right? So I think it's up to 200 grand, something like that for a couple. And the value of the property fits now. That's getting harder in Sydney, right? But you look at regional places like Newcastle. If you're a first home buyer in Newcastle, you pretty much fit the bill, right? And so that's fine. Look, for us, it's forcing us to look outside the square and look at new products and things like that, but also look at areas that that aren't being supported by the government scheme, and how can we support them?
Is there a chance though that the rules would change ever? That as a business, you look at regulatory risk, right, or changes? That would have been one you probably would have got blindsided on. You wouldn't have thought the government would come in and all of a sudden it's 50,000 places. But is there a chance that the banks look at those? There's much better credit decisioning right now, like you mentioned. Looking at credit, they can.
So there's a lot of work.
Yeah,
there's a lot of work we do with APRA on risk. I mean, we've got 60 years worth of data on the Australian housing market in terms of risk over time. And also, as you said, we've seen the underwriting capability of lenders get better because the access to data is much better. And so, open banking and the comprehensive credit reporting means you can really see what, the true nature of a person's financial sort of history is on that. Having said that, people will still, can get themselves into trouble, okay, for all sorts of reasons. People lose their jobs. People have breakups. People get sick. There's all these things that happen that can actually impact that loan, regardless of if they're a good borrower, absolutely, but circumstances have meant they can't continue, right? And that's what puts stress on the system going forward. But we look at that all the time. We look at that.
So when you're buying a property, right, and you're borrowing money for it, you're being assessed, right?
Yep.
When and here you are taking out insurance on behalf of the bank, and that's covering the bank in the event that you default or you lose your job and can't pay, but et cetera, right? But then there's another element of risk here, and that is in the asset itself, right? So if you bought the type of property that's more likely to sell at a loss, then that increases that risk. If you bought a better asset that sell at a gain, then the bank doesn't need to call on the insurance policy. And yet, to my knowledge, the property itself isn't considered in the equation. I know that banks might.
I don't know, it is.
Yeah, so before I go there, can I just finish? I know that banks will do a valuation on a property, so that's assessing what is it worth at the time of purchase. But in terms of the asset caliber and the potential for one property to actually grow in value versus another to potentially lose money, is there any assessment on that side of the equation?
Yeah, we do. So we work with valuers and we do assessment on by postcode, right? So there's the physical property, right? And that's where the valuation comes in. Has it been built, or is it, it's not going to fall down, all that sort of stuff. So there's that aspect to it. So you've got a good quality property. Then we look at the location, and as you know in real estate, location is very important. But and that can vary by postcode, especially when you start moving into regional areas that have a single or a dominant industry that basically is most of the population in that area works in that industry. Right?
Yeah.
And I used coal mines as an example. Okay, so if that coal mine closes, then we've got a problem, right?
Yep.
And so that gets factored in to the risk assessment of where people are looking to buy and borrow. That's as an example. Yeah.
If you look back over time, though, has it been a little bit money for jam a lot of the time, and then you've just had these few freak events, like you say, 2009. How as an insurance company, obviously you've got to basically be proving that you're paying out a certain amount of claims to sort of. How does that feeling for you guys? Is there a pressure on you to potentially make your prices cheaper because you're paying?
Yeah, look, very interesting. At the moment there is, and again, we go through cycles, right? So we haven't changed our pricing in quite a long time, up or down. I think the last time we changed was about 2018, right? Which was slightly on the upside because the delinquencies were kicking up. They've flattened out. The funny thing is, when COVID hit, we all thought we were going to get massive claims, right? And so we had to do a lot of, liquefying of assets and getting ready for the tsunami. And what happened? Property prices went north at a skyrocketing, rate. Everyone jumped online like this and said, "Hey, I can actually work from, Nelson Bay, so I'm going to go buy a house up there, right? But I'll work for a Sydney company." So, you have to be prepared for that, and there's a lot of what you don't know. We are in a benign market at the moment, and yes, delinquencies, they are starting to tick up at the moment, but from a low base. And also claims and what we call mortgages in possession, so people having to be sold up from a low base. And we'll just see how that cycle goes. But yeah, look, we take on what's called 30-year property risk. So when we insure a property, we insure it for the length of the loan, which tends to be 30 years. Most of that risk is in the first 5 years.
Yeah, I'm surprised you insure it for the whole length.
Yeah, and that is a function of history.
Right.
You probably don't need to, but if you said, "I've only insured it for 5 years, with the price different, it doesn't, because most of the risk is in the 5 years.
Right.
It's just we do play claims on 10-year-old loans. Yeah, that is occurring and has occurred. And again, there are certain areas where property prices have not recovered or they've gone down. Right? So, you've got to be careful. The mining collapse was a disaster because there was a massive spike in prices and then a massive collapse. That's quite a rare event, but we're still paying out on those loans. Right?
Yeah.
You mentioned a competitor being the government. There's another competitor, the Bank of Mum and Dad and the Bank of Grand.
Yep. And you can't blame them, absolutely. But the Bank of relatives, I think someone quoted to me recently, the Bank of Mum and Dad's like the 6th largest lender in the country or something like that. But it makes sense, right? You look at this, and the wealth transfer, they're sort of talking from the baby boomers to their kids, sort of starting to take place. And, I've got 2 kids, teenagers, but I'm very concerned about how do I get them into property in 10 years' time, because where do I think property prices are going to be in 10 years' time? A lot higher than they are today, right? So, yes, mum and dad are certainly competing in that space, but we don't. Yes, they're a competitor, but they're not ones we're trying to work against or have anything against, because that makes sense, right? We're all on that boat. What we're trying to do, though, what we have actually, we've got a product where mum and dad put up as a guarantee for a property. But if things change, right, and they want to sell the property or move on, we've structured a product that allows a discounted LMI to be taken up, which frees the parents up to do something, but still protects the bank, which means then the parents aren't locked in. So the initial guarantees when that product didn't exist meant parents either had to sell the house and pay down that debt for their kids till they could below 80, or they had to quickly find another house and then re-guarantee it, which made it complex. But look, bank of mum and dad, absolutely. If you've got the cash, great. But if you've got 5 kids and you're going to look at stumping up $200K for each kid, awesome. But I don't think there's many people. And that's where LMI can help too. So, rather than stumping up $200K for 5 kids, $20K for 5 kids is a completely different proposition, which is about the sort of average price of a premium, depending on what you're buying.
Yeah, I find there's a huge misunderstanding with LMI. I don't want to pay its enormous fee. Don't understand that it's an exponential curve, that it gets more expensive, that there's sweet spots. And I think sometimes parents push the money down on the kids, right? So it's got to get you to that 20% deposit because the parents think it's enormous. Yeah. But, there is risk with giving money down to kids, right? Like relationships and de facto relationships aren't that long, really. And so sometimes the insurance policy is there to protect the kids and the parents a little bit. And so I do think it's something, avoiding LMI at all costs is not sometimes the best option, right? Even when you can take money from mum and dad. And another time I see a huge benefit in is where the clients can get to a 20% deposit, but they have zero buffer and they've borrowed money off their family and they've exhausted all savings. And just to avoid this insurance, and what ends up happening is that makes that next few years, particularly when someone's going for that housing formation, sort of family formation stage and having kids, it's a stressful, that's the danger zone. And I think LMI gives a lot of peace of mind at that time, but you go, I paid, $15,000 for this insurance, which is just an extra mortgage monthly repayment, really. It's just the repayment's a bit higher. But I've got $80,000 in the bank account. And, when I come over the next 2 years, if something happens to my work, I don't have to stress. If I want to have another kid, I can have another kid. If I want to go part-time. I think that's something that, a lot of buyers sometimes forget about, is the benefit of a buffer the LMI provides.
Well, Chris, we need to get you up on the media and talking more with the big guys about that. No, look, that's absolutely true. The way we pitch it is, look, LMI is just one pathway into a house. And I agree with you, Chris. This whole fixation on 20% deposit, it's actually misleading. And I wish the media would get off it and start talking 5% plus cost, or 5%. There's so many 5% things that can help you with 5%, right? Yeah. And the government scheme, that's 5% plus cost. There's mum and dad, because no one will lend you 100% or with no savings. You've got to demonstrate to the lender that you're capable of managing your money, right? So this whole fixation is, I think it leads people down the wrong path. We're one pathway. We're not for everyone, and we get that. We would just love to be considered. I do speak to mortgage brokers who go, no, I hate LMI and we want them to stay at 20%. And I'm going, you're shutting them out, right? At least let them see and hear about it and make the decision. That's all we ask.
Well, the opportunity cost there could be way bigger than the insurance premium, right? So, it took you 6 months' time extra to enter the market. Okay, well, the insurance cost is, say, 1.5% to 2%, right, for them. Has the market risen by more than 1.5%, 2%? Potentially a lot more, right? Sometimes people reduce their purchase price. Instead of buying something at 800, they buy at 600 because they don't pay LMI. But 800 would have been a much better asset, right? And given them a much better runway, might have been a better investment, etc. So, I think people make decision. And insurance does have the people avoiding costs for, without understanding the opportunity cost is a big problem.
That's so true. It's just you look at one side of it, not the other. The example I like to give is I use the Sydney market, and for ease, so look, if you look at over the last 30 years, you use core data, depending on what period you pick, property prices in Sydney have gone up between 6 and 8% per year, right? Every year. Now, look, and there's up and downs, but on average, 6 to 8%. $1 million property, if you borrow 95%, so $950,000, the LMI on that is just under $40,000, right? You go, whoa, that's a lot of money. Yeah, but if you've got $1 million property growing at 6%, by the end of the year, you've made 60 grand, you've paid the LMI, and to your point, Chris, you've got in early. Otherwise, if you waited another year, you pay an extra 60 or 80 or whatever it is each time you wait. So it very much is something that can get you in and get you going.
Yeah, I mean, you could probably halve that LMI as well if you got it to 90% as well. So what we find is a lot of clients get to, 92, 93, and I go on, rattle the tin, see if
Makes a big
you find that extra just to get to the 90% mark. And like the magic number for us usually is at 88. We find that the drop's quite significant and the cost of benefits, quite big. And, it starts to taper off, right? You don't get huge benefits and you go to 86, 85.
No, that's true.
You with, it's a new policy that's come out from ANZ. We're on the pilot, right? There's about 30 brokers that are on it out of 19,000. And it's for purchases over 2 mil. And you can basically borrow up to 95% without LMI. And
95 without LMI.
And you can buy potentially up to $8 million in certain postcodes. A lot of them are around 5, 6, 7 million. Have you heard
Jumbo loans?
Have you
Yeah, I have.
this?
I have.
What's your thoughts on it? How are the banks doing this? And how's Helia?
So the only guys that can do it are what called internally rated banks, which is or IRB lenders, which is your 4 majors, Macquarie Bank, which is sort of being viewed as a 5th major, and ING. And what that means is all other banks have a standard mechanism for assessing capital they have to hold for their loans. An internally rated bank can actually manage through quite complex mathematics, can manage their capital requirements differently, which means if they're lending up to 95% on a $2 million property, their capital requirement is a lot less than, say, what would it be, like an AMP that was lending, or a BOQ, or one of those guys. It's quite significant, right, in terms of the difference. So the cost for an ANZ to do that is significantly lower. Now, there is more cost, don't get me wrong, but they're doing what Macquarie probably did 5 or so years ago. They're chasing your high net worth or high income, so not so much worth because they haven't got anything, but they've got lots of income. So your lawyers, your doctors, these are guys that, but 5 years out are earning quite significant chunks of cash, or a couple, and they can service it, right? Yeah.
Mm. And what's your sort of take on these policies starting to come out more and more, where the banks are willing to kind of self-insure? And
that impacts our business. It's interesting though. We do find, so one of the other services we offer is it's called bulk insurance, which we tend to do when lenders, and mainly non-bank lenders, do what's called RMBS, so retail mortgage-backed securities, when they sell big chunks into the bond market. We do find that some of the big lenders, when they've done that, then the risk profile gets too much. They actually come and do a separate transaction with us in the back end. But look, that impacts our business, right? So, but it gets people talking, and we like people talking about LMI and how they can get into property. So we do get a bit of a halo with those that don't get that benefit as well.
Usually how people talk about LMI is how to avoid paying it.
Yeah, that's true. Absolutely.
So how are the premiums calculated? So you've just been talking about an exponential graph, basically, and the higher the LVR, then the higher the premium, down to 0 at 80%, right? So, but why is 12%, saving up 12% like magic? Obviously the actuaries have got in there, and when, at that point, risk really falls on.
You got the propeller heads, right?
Yeah.
So they've sat down and something. talk to some of them, and it's quite an interesting conversation because they're talking it way up here, right? But look, they do some pretty impressive mathematics. It's based on a lot of data we've had over like 60 years. And, even when we started, we were using bank data from even before then about how loans perform at certain LVR bands and certain sizes, right, over time. And what you see, as I said, why do they draw a line at 80? Is because there was quite a significant shift in performance of loans when you went from 79 to 80. And it's borne out by history. And then what we found is, and then there's a sort of slight, even curve as you go up. And you're right, 88's a funny position. It sort of plateaus, hit 90 and it kicks, right? And then it travels up, and then at 95 it kicks, and then 100 it kicks. We used to do 100% loans as well. 100 it kicks. We may see, because of what's happening with performance at the moment, we may, and with what the government have done, we may be sort of seeing 100% lens in the not too distant future as well, because we're getting better at it and we're willing to take a bit more risk.
So can we talk about that risk? Because we talked earlier about, you got 60 years worth of data, not just lending data, but you'd have 60 years worth of data on payouts for actual properties, actual locations. Now, the mining towns are a bit of an obvious example because, let's face it, if anyone has a memory that's just about 10 years ago, 12, 13, 14 years ago, there was a mad panic for every investor in the country seemed to want to be bragging about their mining town purchase and the amazing rent they got and the amazing capital growth, and everything was running away. Then some mines closed down and you saw their values fall off a cliff, really. Now, people with their back teeth underwater there. I mean, but that's an extreme circumstance. Then you got your mums and dads or first home buyers buying house and land packages, and you've got right through to off the plan units, and you've got established property. You've got quite a wide range of type of property stock that first home buyers could be buying. Where is the riskiest outside of mining towns? What's been the riskiest type of property for first home buyers?
Historically was the big developments where you've got 1,000 units in a single development, and therefore what you have for a period of time is oversupply, right? And this is where the governments totally get it wrong in terms of how do you fix the housing crisis? You build more homes. Simple as that. The more money you throw at it, you're just pushing prices up. Even the government guarantee is pushing prices up because you give people more money, right? And there's a lot of people that didn't need the guarantee that said, I'll take the guarantee and use that extra cash to buy a better house, right? So, and that pushes the property price up. And so what we saw and again, this is cyclical. At the moment, the oversupply, there's no oversupply, right? We used to monitor postcodes all the time. I think at one point we had probably 40 postcodes that we deemed oversupply. That's now currently at 0, right?
Right.
Because
wow.
If you try and rent a property today, and I sort of don't know this, but we've got young kids, they're in their 20s, but they're kids, here at work, and I was talking to them about how, they're talking about their trying to get a house, trying to, rent a place. There's 4 of them together.
Yeah. And
what they've got to pay is astronomical. And plus they're turning up to open houses and there's 40 people there, right? So at the moment, that historically oversupply is another indicator of you're going to have issues with price. At the moment, it's not there. It will come back. The government are trying to build 2.1 or some ridiculous number of houses quickly. That's fraught with, there you go, other way around. But that's fraught with danger because there's been no thinking and planning behind it. Yes, we need more, and we probably need double that, to be quite frank, but you need the infrastructure and you need the quality and all that sort of stuff. And so, there's risk in that, right? Suddenly we're going to get a gazillion houses built in a very short period of time, and therefore you've got to make, is that demand going to stay there? A lot of that demand is being driven, especially in the rental space, being driven by students who are not going to stay here, right? So, it's tricky. But oversupply is probably the other big risk factor that we look at outside of what we don't so much call them mining towns, we call them single industry towns. Steelworks, fishing is another one, that closes down. So things where the local population are very dependent on a single industry, regardless of what it is. You got quite a bit of risk there if that industry shuts down, right? So, it's one of the factors.
I'm on a personal mission to help more people make better property decisions. And you can find out all about what I'm working on at veronicamorgan.com.au. And there you'll find resources for first home buyers, details about my buyer's agent mentoring program, access to suburb help for investors, or if you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers.
If you're thinking about buying your first home, upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out via our website, wealthful.com.au.
You guys must be laughing. I guess not laughing is the wrong word, but, not be surprised at the amount of competitors that try to come into this space. I mean, the government's also doing things like home equity scheme, right? I know that's getting some traction around where you give up actual equity in your home so you get less capital growth, right? Less returns, but you're in the market.
Yep.
So that's great. But, there's a cost to that, an opportunity cost to that, where essentially you could have used down the line a one-off fee or cost that would have got you into the market, and you wouldn't have to give up 30% of your growth. I mean, you've also seen this explosion, I would say, of Fintech, Proptech, sort of. You got things like Frontier and Own Home and Sukasa. And what's the Helia's take on that? Because a lot of those are a timing play, and, they're trying to replicate what 60 years of Helia's data and tech and, and then trying to overlay that maybe everything's not a risk in the property market. And, then I think they're coming at it from an opportunistic point of view rather than, potentially.
Yeah, often they're driven by personal experience. So we know the guys at Frontier, that was driven by the experience of one of the guys trying to get his kids into homes, right? So, and look, all these things are valid potential options, right, that they're doing. We have looked at these things. Last 20 years, I understand, but certainly I've been here for 7 years. We've been investigating the market about all different things that, how could we challenge ourselves, right? How do we disrupt ourselves? And that's the sort of approach you go at it. And we've looked at shared equity. We've looked at, you're sharing the deposit. And we're looking at deposit bonds. I mean, there are deposit bonds companies as well. There's all these different things we've looked at. They work to a degree, but LMI is very simple and, probably not elegant's not the right word, but it's a very easy way and it's less risk for the actual borrower and it's easy to access and then use. And I agree with you. Look, shared equity, fine. In fact, the mum and dad bank has probably been the leader in shared equity because the smart parents go, well, I'm not going to give you money for nothing. I'm going to have skin in the game, right? So, and especially if boyfriend or whatever or girlfriend decides to depart and wants in, right? So that de-risks that whole thing. The shared equity with government involved hasn't been that successful. Yes, may not, because borrowers tend to get a bit suspect of governments. And to your point, Chris, why would you want another party to get the 40% of growth where you're doing all the heavy lifting, right? So, and I think LMI is a great alternate to this shared equity piece, and we're certainly backing ourselves in that space. It is another competitor that we look at. The fintechs we play a lot of attention to. So far, none of them have actually cracked anything that's of major concern to us. But you never know. Someone comes up with an idea and we go, we didn't think of that. That's something we should really look at.
Yeah, I can consult with pretty much all of the guys, because they hear about us online and they're like, I wouldn't mind you, broking, would they be able to use it? The challenge with a lot of them is that, ultimately the funder on the other end is the bank, right? And, if a bank's going to lend you 80% or 90%, they're going to say where the remainder is coming from. If it's coming from a different policy or a product or a person, who is that person? What are they doing? Are you going to pay them back? Is it a loan? Is it equity? If we have to sell the property, I've got to pay two guys out. And a lot of them just don't understand the complexities around bank lending and serviceability. Yeah, you could create a cool product on the tin, but to actually get the ability to win all the banks on board, not just one bank, really hard. And I think that's I find that a lot of first-time buyers get very excited by these things that usually get good marketing behind them, but they never take off, because it's really hard for them to get the banks involved. Is that sort of your experience as well?
Yeah, absolutely. And look, we even invested in a very small one looking at deposit gap lending and all that sort of stuff. Didn't go anywhere. We learned a lot from that, and that was probably what, we didn't think we were going to make $1 gazillion off it, but we wanted to see how it would operate. And it was exactly your point there, is the lenders were going, I'm not sure how I play, or where's the risk, what happens because banks will always say, what happens in the downside, right?
Exactly.
So where's the protection of my asset and all that sort of stuff? And a lot of the guys that go into it are not from the banking sector. They generally have had a personal experience with kids or whatever and go, I can solve this and charge in. So, and that's probably why most of them to date, I'm not saying they won't, have not gone anywhere. Yeah.
It's funny that you say that, because I listen to the Proptech podcast on and off, and I go to conferences and I speak to people in Proptech, and I'm always fascinated, where'd you come from? How did you get into creating this supposed thing that's going to solve everybody's problem in real estate? And so it's not so much on the fintech side of things, but it's the same thing. It's like, I went to buy a house and I found it really difficult to make offers, and I found that there was no transparency, and I found this, and I thought I can solve this, and it's like, and then they misdiagnosed the problem. So like classic in the fintech side of things, the bank's part of the problem and they misdiagnosed it, totally forgot that they're actually a really integral part of it. The same with the Proptech side of things. They just assume that the only people you can't trust in the whole side of the equation is sales agents. They don't realize you can't trust buyers and you can't trust vendors either. You know what I mean? It's just like, you can't trust anybody when it comes to lots of money. You just can't. So it's quite fascinating. It's
a really good observation. I think that's spot on across that whole industry.
Yeah, and it's like all the clever brains putting their their thinking towards it without really proper diagnosis. Now, with you've been in this space a very, very long. Well, Helia's been in this space, different name, same, it's a different coat, for a very long time. You do have a lot of data at your fingertips, a lot of understanding. What do you think? And you talk about, you think that the $1.2 million dwellings that the government's promised to build over 5 years is just, you don't seem to think that that's possible. How does Helia, what sort of things are you coming up with to sort of solve this affordability crisis?
Yeah. So there's a few things. Some are quite basic and only little. So one thing to help with a bank and mum and dad when they've got multiple kids is we'll offer a deeper discount on our product, 15% if you pay the LMI up front. And the reason we can do that is that for us, we hold less capital on that. And
all right, so the alternative is that it's capitalised and it gets paid out over the life of the loan.
So,
right.
Most people, I think 90% or maybe even 95% of loans, when you take LMI, it just gets added to the loan, which adds a few dollars per month to the actual repayment.
Got it.
And you move on, which is why it's very simple to do. But look, mum and dad are sitting there going, okay, I've got 5 kids. I can't stump up $200K each, but I can pay the LMI for them, and I'll do that. Then they get an extra discount, so they don't pay as much. So that's the first thing. The second thing we've been looking at is actually in the small business space, because a lot of small business operators out there that manage their business and their home together, and it's what can we do to actually cover both the lending in that space, because that's often quite an issue for lenders in the small business space. It's like 2.5 million small business out there. Let's try and help that. And on the first home buyer piece, a harder one because we're competing against free, but we do offer deeper discounts in that space as well. And now we're starting to look at alternate products, which is where, would we get into shared equity and how would that work? Would we get into something to help with the deposit and how would that work? A lot tougher, right? A lot tougher to understand that. Just dropping our price, that's always on the table. But again, we take such a long view. We've just got to be very careful at space. And as I said, delinquencies are starting to tick back up again. And so we're just going to be mindful of that going forward.
Have premiums fallen over the time? You did say that the banks are getting better at basically assessing, I should say, borrowers, potential borrowers. Have premiums fallen as a consequence of efficiency?
Yeah, depending on the lender. So we do. It's not one price for everyone, and I suppose that's something to know as both the broker, which you probably do, and a borrower, is that check the different. If you've got a similar rate, check the different lenders because you could get a different price.
Right.
The reason for that is lenders have different performance histories in terms of delinquencies, right? And you've got to factor that into your pricing. Right? So some lenders...
So Helia will have different pricing for different banks. It's not like a bank has an insurance company they work with and that insurance company has a different pricing model. It's the other way around, right?
Yeah, it's based on performance. Yeah. So it's definitely worth checking because it does vary.
Do you find that
If you've got that.
I mean, your share prices, I know we've spoken about a lot of competition here and Helia must be going under. When you look at your share price, it's gone from the lows of low $1 over $4 now. It's, it's doing quite well, right? So the outlook for the business is quite strong. Do you think that that's just the confidence around property price growth over the longer term that, that people don't think that the risk is there like it was and we're not expecting any major collapse? Like how is it, or is it, what do you think the strongest of the share price relates to?
Oh, me. They know I'm here, so they're backing me. No. Look, it's looking at our... so every time we report, we show delinquencies and we show what our premiums are being written, all that sort of stuff. It's looking at the market. There's a lot of factors that go into this. At the moment, it's probably about... so premiums are down from the historic highs of 2020, 2021, but they were massive bullish years. But they're starting to pick up again, and delinquencies are pretty much very low and flat, right? As I said, we're starting to tick up, but we're not seeing anything that would scare the market. Look, the Australian financial system is pretty well run, on the whole, compared to globally. And so a lot of investors, we've got institutional investors, they're willing to take, or they can see there's a good risk to take with our stock, and we pay good dividends too. So that's the other thing that they get.
Do you find that there's also, you'd think, only a first-time buyer would pay out of mine. But, ultimately now, when they walk away, they bought the apartment's gone from $1 million to 1.1, maybe 1.15, and they had their $900,000 loan. Now they've got $300,000 left over, and they want to buy something at $2 million, and they need $500,000. Like, do you find that there's this upgrade is becoming more and more common, and as a growth for you, because it's housing affordability is getting pushed down.
There's still a grudge purchase view on LMI, and so people will go, "Oh, I don't need it anymore. I'll upgrade at the 80% level, so I'll avoid it." I think that's mad. You could go to 90, you're going to open yourself up to a much greater property and probably a return as well. So it's an opportunity for us. A lot of the work we're doing at the moment is around education, both with brokers and actual borrowers as well, about don't shy away from the cost. Get a bit smarter about what you're thinking about. The other big growth area for us, which is now coming back on, is in investment, in the investment space. So you people that either can't get into where they want to live, right, but they can buy a house up in Queensland or Melbourne or wherever, and they can get in. So that's one. The second one is people that have got in and they have $200,000 in equity, right? And they're going, well, rather than buy a new property, I actually can buy an investment property and start building a property portfolio, right? And I can get into that investment property with 5% plus cost or 10%, whatever it is. And the LMI cost, because it's a cost of doing business, cost of your investment, that's tax deductible. Right?
Yeah,
both areas.
But if you as a insurance company, I always I look back in the financial advisor days. We did a lot of life insurance, a lot of income protection, and people would take it out in their 30s and they get to their 40s. Yeah, their wealth's getting bigger and stuff like that, but the chance of claiming is really low. And then as people they usually cancel their properties at 46, and most likely getting most claims at 47. Right? It's just that people usually close just before they're likely to claim because the cost gets prohibitive. Just sort of Helia, when people take out insurance on their home and then as soon as they get under 80%, they refinance, right? And they go to another bank. And do you sort of love that as a business when obviously that they lose their insurance benefit, right? Whereas they could have reused that insurance to reborrow and pull equity out. Do you find that that's a real misconception in the market? And you see these properties go off the bank's book, which is great for you, right? Because your insurance risk has gone as well. Yeah. They should have stayed with that lender.
It isn't. Yeah, so we prefer to have them on because they're actually less risk because they've given you, because what we call that, it's a seasoned loan, right? And you've got performance history, right? So you go, hey, these people, Mr. and Mrs. Smith, they've been paying this for the last 5 years, haven't missed a beat, and two things have happened. The balance has gone down and the property value's gone up, right?
Yeah.
And they go, hey, let's refinance away because we can get a cheaper rate or whatever. Or, this is what, again, you're right, the banks are sort of missing this. Hey, you can borrow more, right? You can actually borrow more. In other words, top up the loan. And if the loan goes higher than what it originally was, then you pay a little bit more insurance, but you get a credit for what you've already paid. But if you go to another lender, you don't get that credit, right?
Right.
So it might cost you an extra $3,000 or $4,000 now, but if you go to another lender and you want to do the same thing, the same strategy, you'll pay full freight again. It's
If they refinance, right, and they actually took LMI out in the first loan, and so that's been amortised out through all the repayments of 30 years, but they're obviously not going to have that loan for 30 years. Do they just stop paying, the LMI contributions, or do they have to? No.
Two things, yeah. So if most people pay it up front, and that's just part of their loan. They've got a loan. I keep paying. We do have a monthly product.
Oh, I see what you mean. You got paid, but
we got
bank. Yeah, okay, got it. Yep.
So, but also we do have a monthly product, which we've had out for a couple of years now, only with small lenders at the moment because it is a bit complex to put in. And now the monthly product works is instead of paying the full amount up front, you just pay monthly, right? So instead of paying $20,000, you might pay $200 a month. And then what happens is when the loan drops to 78% LVR, and the reason it's not 80 is because values do fluctuate and banks just need that buffer. It stops. You stop paying it. Right? Oh. And so for some people, especially if you're borrowing around 85 to 90, that makes sense because you can usually get that down within 1 or 2 years. Mm-hmm. Instead of paying $20,000, you might pay $7, right? So that's it. We've got more lenders lining up to take that on. You'll see more of it into the future. In America, it's 80% of the market. But, that's a product that is coming.
I guess the takeaway for listeners here is if you've ever paid LMI on your property, whether it's a home or investment, just be really careful refinancing out of that bank. And you really want to explore whether you should potentially reuse that LMI to release equity, whether you're going to use it for renos, whether you're going to use it to do other investing, etc. Versus sometimes chasing a rate and maybe that 5-10 basis points, if at all. There's the opportunity cost that a lot of people don't factor in. So they'll go to another broker, they'll walk into a bank, they'll get offered this rate, and then 6 months later they go, oh wow, actually they didn't even know, to be honest, that they could have just stayed at that lender and reborrowed back up to 88%, which gave them access to cash to do other things. It's from a Helia point of view, that does go off your books, right? Because that risk is gone. You've got the money up.
The risk is gone. Okay, so risk drops off, correct.
And it's just, but the borrowers just missed that opportunity.
They have. Yeah. And the other thing you've got to understand is risk is not bad. Risk is risk, okay? And with people that have been paying a particular loan for a period of time and they've done it on time, then that's good risk. And we'd prefer to have that on our books and work with lenders and say, hey, these guys are good. How about you work with them to help them build their wealth using that property? Absolutely. Chris, we need to get you to talk to some of our other guys as well on that.
This is a classic, Ashley, because, I've been doing a podcast every week with Chris since the beginning of 2018. So we just went over 6 years, right? We don't even celebrate, do we? We don't even go, oh, yeah, happy birthday. But I didn't know that. And I'm in the property space. I've been in real estate for over 20 years, and I actually didn't know that. Now, this is one of the things that I talk about with, buyers agents I'm mentoring, et cetera, et cetera. We're always learning new stuff. And certainly it's a really good example about the difference that a mortgage broker is thinking strategically and is advising you in the bigger picture rather than just chasing rates. It's a really good example why those conversations that pull out all those and discuss and throw up ideas about other options and how that they can benefit you. So yes, I think that's really good.
Well, we just glossed over another one there where you said about tax deductibility for insurance for investors. That absolutely is often forgotten about. So it's best practice, absolutely. Refinance up to 80%, assuming you haven't paid LMI, right? If you have paid LMI, maybe you go a bit higher. And build yourself a bigger buffer and then borrow at 80% on your investment property, right? But it's not always the best option. Sometimes you're better off, like particularly when your buffer's getting tight, because the danger with investing is you have to sell assets, right? And they usually have to sell assets like any business going under. It's when you run out of cash. And so what you should consider is, in the scenario, is do I pay 88% on this investment property? I still fund the 12% plus the stamp duty and costs. But the LMI cost, let's say you're spending $1 million and the LMI cost is $18,000. Well, that's tax deductible. Your top tax rate or your 40% tax, it's going to cost you $8,000, $9,000, $10,000 out of your pocket. But
hang on a minute, it's capitalised for deductions, or
it's a five-year borrowing cost.
Right. Yeah. Okay. So you get it back to
5 years.
Yeah.
Over 5 years. So
you get a benefit, right? And it needs to be factored into your thinking.
Yeah, it's not just when you sell it. Like your stamp duty, you get back. You can use it as a deduction when you sell it against your capital.
Yeah, because I think so. Sometimes people go, well, it's I've got $200 cash, $200,000 cash out, 20% deposit. I can spend $800. Well, yeah, you could, or you could spend $900 or $950, pay LMI on that property, which is taxed up over 5 years, and get more money in your pocket, right? As a
and get a bigger asset,
potentially a better asset. And I think it's that's a missed opportunity for a lot of investors because you have to have the servicing for all this as well, right? Like that's a factor in this. You have to have the servicing.
Oh, yeah, absolutely.
Yeah.
And I think that the key thing out of all that is you need to stop looking at LMI as just a cost. You got to start thinking about what do I want to do and what can this enable me to do.
The tool.
Now, if you look at it and you get to a point where I can't afford it, I can't do it, fine. But just have a look at what it can do for you, right? And then as you're thinking, you mightn't use it, doesn't matter, but at least you had that as a consideration.
So it might be a simple product, but the applications take a little bit more of a complex mind, perhaps. And if you go have a broker who can't sort of have these discussions with you, maybe you need a new broker.
Yeah, that's true.
Well, I don't know any good ones anyway, but I mean, on this point though around serviceability, because there's four and a half times borrowing, of your income, maybe 5, maybe 4, depending on your income. It's really hitting lower incomes, right? This is Helia must see the pressure in this. The average loans are dropping, right? Whether they're actually going up, in fairness, it's surprising because why they're going up is because it's the top end of the market that are borrowing.
That's right.
How's your Helia's take on this? And is there a little bit of pressure that you and the banks can provide to the government and APRA to is that because ultimately it's in your interest, in the bank's interest, to the first home buyer's interest to start to relax serviceability. And, are you getting consulted on that with the government? Because
we talk to them all the time. And the lenders. The lenders are doing the same thing, right? The buffers were an issue that they reduced a bit, but they've come back out, I think. And in a way, they were a good thing when you're down at 2%, we're now at 6%. 2%, they were rating it at 5, right? And we've now got rates at 6, so that's protected things. But we're talking to APRA and ASIC is another one, and also the government on all areas that we think we can help to actually stimulate people getting into property, right? Some of it falls on deaf ears. Other stuff they take on, but APRA are very much about protecting the integrity of the market, right? So and they're very. If we start talking about ideas that could actually inflate, and inflation's an issue, then that sort of at the moment gets canned. And with the recent budget, we'll see what happens.
Do you think you're going to go down to a property level? I know you talk postcode level, and and insurance is meant to try to protect as many people as possible, right? Like even with their household insurance and floods, like. When you start not being able to insure areas that are more prone to flood,
climate risk is the big one, right? Yep.
But like if I was an insurance company, I'm like, well, I'm not going to protect. I don't want to protect these type of people or these type of borrowers, or because that's where my risk is. But that defeats the whole purpose of insurance. You basically marginalise society. So, do you think that you will go down that direction, though, at all, and you'll start saying, look, we're not going to high density is all the risk. We just got no one out of that, but we will in this suburb take the low density apartments. We will take.
Yeah. No, we do all. We were insuring. We insured identity but we just didn't go up to 95. Right. So we just tweak things. Look, climate risk is something that we're all turning our attention to. When I say we, I'm talking like banks and us to try and understand it. We've done a lot of work looking at. There's two key things on climate risk. One is looking at disasters like flood, storms. What else was there? There are a bunch of different natural disasters. Bushfires, thank you. Yeah, bushfires. So looking at that, where they're happening and what can we do about that, and what's the impact over time. And it varies. It's very hard. There are some general insurers that won't insure above what they call the Tropic of Capricorn at the moment. You'll hear that in their little caveat at the end of their ads because they deem that the storm risk above the Tropic of Capricorn is too great. The other one for us is then what we call transition risk. And this is when, mining towns close down because they're coal to electricity. So how is that town going to transition? Right? There's work going on that. But at the moment, we've got there's nothing that we're looking at that would stop us from insuring someone who borrowed a house in Cairns, bought a house in Cairns, things like that. We're not doing that. We work, most of the big lenders that we work with wouldn't do that either. But it's something we're looking into about, well, what can we do? Because you're right, Chris, you can't just say we're not going to do it above a certain point because you're going to really strand people. That's where you work with government, with state governments, right? So, and I know the Queensland government, I know I've got a separate insurance fund set aside to help with that because they obviously have to help all their people. But it's very early days at this stage, but there's a lot of work being done.
Yeah, it's an interesting space.
Property dumbo. Have you got a story for us?
Oh, that's me. Yeah, I waited.
Good.
And I even this was waiting to try and get my. It was actually a 10% plus deposit because when I was at Westpac, once they would lay it or borrow up to 90% without a deposit, and so I said, right, I'm going to get my 10%. I could have borrowed at 95 plus exact and paid LMI, and I didn't. It took me 18 more months to save, and property prices have gone up by about $250,000 in that space.
Oh, so you're talking about it when you're at the bank. The bank give us staff employees.
This was back in the late 90s, I think. When did I buy my first house? 2000. And so what happened was the bloody Olympics and all that came, and property prices went up. But I went, I didn't have to pay LMI, and it wasn't until someone later pointed out to me, you nubbed it. You bought 2 years earlier. You would have paid. I think I paid like $550,000 for a 2-bedroom unit. He said you would have paid $450 or $400. I went,
yeah,
okay. Look at Mr. Smarty.
Oh dear, love our own stories. Oh dear, it's if I talk, I've got dumbo. My first property was a dumbo too. It's sheer luck that didn't end up.
And then the other dumbo thing is I bloody sold it when I should have kept it and rented it out because now it's worth a freaking fortune too. So that was the other thing where, if someone had advised me try and keep it and rent it out, which I could have done in retrospect, I'd have a bigger property portfolio. So that was the other dumb thing that I did.
Yeah. I once worked backwards and counted the cost of all the things that, in retrospect, I wouldn't have done.
Oh, you were brave.
I worked out it was about $2 million equity in it.
I don't want to even look.
Yeah. So that would have been the perfect, every move perfectly calibrated. And
you're never going to do that.
Yeah.
But I think it's our experiences, our failures and follies of people on this podcast. If anything can help you not make that mistake, then job done, right?
Absolutely. In fact, one of the big reasons behind Homebuyer Academy, your first homebuyer guide, is that don't make the mistakes we make and the mistakes we see so many others make. We can help you avoid them. All right. Thanks so much, Strachan. That's been a really interesting chat.
Yeah. Fantastic. Thanks for having me on.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.